How you doing, folks? This is Adam Carlini, Grant Haddon, and Gary Luna from Dynamic Wealth Management. This is our first attempt to do a monthly video update. We hope you like it, and more importantly, we hope that it is informative and gives you an idea of what we're thinking, how we're watching the market, and of course, how we're taking appropriate allocations in our models, given what the market is showing us as well. We will appreciate any feedback you have for us. We hope to be able to do a video like this each month at the beginning of the month. And of course, if there is a need as well, we can put out intermittent videos throughout the month also. But we'll go ahead and jump into things, give you an update on where we stand. And the first thing we need to let you know is that according to our key market indicator, we are at a risk neutral area. And in fact, if we were to do this more scientifically, this thing would be a little bit more over here, and we'll work on that gauge for you in the month to come. But basically, we'll explain what that means, how we define the risk on as compared to risk neutral and risk off areas of the market, and then how we take appropriate action according to those risk indicators. Let's go ahead and start off with a market update, give you an idea of where we have been, where we are now. What you're looking at is the S&P 500 over the last 9 months, and you're looking at a chart on a daily basis. This is the recent market action as we have broken down, picked up and broken down again. Notice that over the last really 6 to 9 months, we were really in a tight trading range. In fact, if you pick a point here, you'll notice we were at that same price point all the way back here 9 months ago. We were hoping that in this trading range, as we were bouncing between levels of support here, here, and here, levels of resistance here, here, and here, that we would finally break out to the upside. Of course, we have not. We have broken out to the downside. A number of things pressing on this market right here, including China, the potential for the Fed raising short-term interest rates, and so forth. So notice that we have broken down over the last couple weeks. We finally found some level of support at about 1867, in which we bounced back for a couple days, and then we bounced up to this level of resistance at about 1993, and over the last couple days we have bounced back down a little bit here. And so we are right in the middle of key levels of support and resistance. So where do we go from here? Well, let's take a step even further back to get some perspective on this bit of a downturn in relation to the broader bear and bull market that we have been on. So what you're looking at here is now that same chart, but going back for the S&P 9 years. And now every one of these marks is a month in time. Notice that we have broken down over the last couple months, and we are now just below that 20-month moving average line. So the big question is this for us. Is this bit of a breakdown that we have gone through, is it going to be similar to a 2011 situation or a 2010 situation in which the market broke down for a couple months, we dip below those trend lines, finally we find some support, the market gets some confidence back, and we ease our way back up and the bull market continues? Or is it more similar to this breakdown that we had in 2007, where every time the market would go down for a couple months, any bounce backs were just back to trend lines and down we go again? The answer to that question is we quite frankly don't know. And so we're going to play it cautious, and we're going to allow the market to dictate to us what is the appropriate allocations for our models going forward. A couple other indicators that I won't go through in a lot of detail, but basically what you're looking at is, again, S&P 500 stocks. These are the number of stocks that have broken, that are still above their individual 50-day moving average and their individual 200-day moving average. So 15% of stocks are still above their 50, and about 29-30% are still above their 200-day moving average, basically indicating to us that a good number of stocks, the breadth of this downturn, has increased on the way down. And again, we haven't seen that going all the way back to 2011. And it was the last time we saw that type of a broad sell-off in stocks. That does not necessarily mean that this is the bear market, because again, stocks picked up and we started the next phase of that bull market. Another couple indicators that we'll throw in on a longer term as well. Notice here you have a couple indicators in MACD and rate of change, and we did have a change in the MACD. You have the red line moving average dipping above, or actually the black line dipping below. We have not had that situation since back here in 2011. And notice what happened at that point. It was a head fake. We dip below, but then we gain again and pick up, such that we bought. The indicator was saying to get back in. So sometimes you have head fakes on these type of indicators, but sometimes it indicates this is the drop. And then you have rate of change that is getting ready to cross over the zero line, and that usually indicates, again, a bear market. But we are right near that line, near areas of support where the market has picked up from there as well. So then, how do we handle this situation? Since that we are in the middle there, how do we allocate appropriately, and what do we do, and what is our game plan? I'll have Grant go ahead and pick it up from here and go ahead and walk us through what that game plan looks like for us.
Hey everybody, we are very excited at Dynamic Wealth Management to be doing these videos on a monthly basis. We think it is going to give us an easy way to communicate with our clients about what it is that we see in the marketplace and what it is that we anticipate doing with our allocations. Hopefully it helps our clients feel more comfortable about knowing what we're thinking and where the markets are. So Gary did a great job of showing you where we are right now. He also showed you our risk indicator, and he showed you that it is right now risk neutral as we calculate it. And so I'm going to talk about a little bit about what that means, about how we calculate it, and how we change our allocation. So you'll notice here we have this black line. The black line looks very similar to the S&P 500, but it's not. It actually is a ratio that just simply tells us when the black line is moving up, the ratio is going up. It means that stocks are relatively stronger than cash. So you would have been better off allocating yourself into stocks during this time period. During this time period, when it's falling down, you would have done better in cash. So that's simply, it's real simple, right? We understand the concept here. So as this black line moves up, it was better to be in stocks. It moves down, it was better to be in cash, and vice versa. So then, on this ratio, you'll see these two lines, a yellow line and a red line. And we've put a ton of effort and research into drawing these lines in the sand. We won't get a ton into how we calculate them. But basically, when this ratio drops beneath the first level, beneath the yellow line, then we move to a risk neutral zone, or regime as we call it. And when we drop beneath the second level, the red level, well, now we're in a risk off, and we change our allocation. So when things are moving well, and when we're above both lines, we're in a green risk on zone, and we are going to be allocated more towards equities and risk on assets that will participate with the market to the upside. When we go risk neutral, well, we're not going to totally get out of the way, but we're going to reduce our exposure, and we're going to prepare for a red zone. Basically, goal number one for us and for our client is to reduce risk. We want to align ourselves so that we don't lose big money in the down market. That is our main goal, is not to have big losses. So that's what the yellow zone does for us. It starts to transition us away from equities and more to a defensive allocation. Now, when we go beneath this red line, we are going to go really completely defensive. We are in a risk-off zone, and we want to protect our clients at that point. So what does that look like going forward? Well, again, this will simply show you a little bit closer zoomed in what we're talking about. So as the black line is above, we will be in a green risk-on zone. And then as we fall beneath the yellow line, risk neutral, go back up, we'd go back to green. And so you understand the concept. Actually, where we are right now is we're hovering just above this red line. And we'll show you that a couple charts in here. But that's really where we are. So we're yellow, and we're currently allocated as a yellow risk neutral allocation. And we will be taking signals for this model, and we'll be doing that actually on a weekly basis. So you can see all these little red dots here. They really would represent weeks. And as we are beneath, then we're going to stay allocated defensively for all these weeks. Maybe we'll get a week where we go up into a yellow allocation, and we'll take some positions. Sometimes, obviously, we will not always be right. We could go back down and go red again. But the idea is to catch the major moves of the market. So here's a chart that shows you really when we would have been allocated to green or risk on, when we would have been allocated to yellow, risk neutral, and when we would have been allocated risk off or red. So you can see most of the time we are in a green risk on situation, and that's what we like. That's where we want to be. That's what we want to capture. We want to be able to do these videos and give you an update that says last month we were mostly green. This month it looks like we're going to be green again. So those are the signals that we like, of course. Now here you'll notice we were green. We broke through the first level, the yellow level, and we took a yellow allocation. The market continued to fall, but we were more defensively allocated than we were before. And as it continued to fall, then we went red, and we said we were completely going to step out of harm's way and get out of the way of equities and a risk on assets. And so the question often is, well, where did you run? What would you allocate to? And the answer to that is really we would go to short-term bonds and treasuries for the most part. So any assets that we would expect to go sideways in a declining market. And that's not a guarantee, but just historically we know that treasuries and short-term bonds tend to hold up well, right? And so that would be the goal of this as well. So like I said, as of right now, we are in a risk neutral zone. So what that means is we have it broken up into our three different risk tolerances here. For a growth client, it's a little bit more on the growth side. They would be allocated as a 60-40 in this yellow zone, 60% equities or risk on assets, 40% defensive assets. A moderate client would be at a 40-60, right? So 40% equities, 60% bonds and treasuries. And a conservative client would actually only be 30% in equities at this point, and 70% on the defensive assets. Of course, as we move to green, we would change the allocation to a green, right, for our three different risk tolerances. And if we went red, then we would completely sidestep risk on assets and go more to the defensive side. We think that makes more sense. So this is a chart, right? This is going back to 2007. So it shows the big decline of 2008, and then it shows this this strong bull market that we've been on here for the last 5, 6, 7 years now. So the question on everybody's mind, and that's what we've talked about, right, is this blip here going to be like 2011 or right here, or is it going to be like a 2008 situation? And as Gary pointed out, we don't know. What we do is we let price dictate to us what actions we take for our clients. If we are going to make changes, we want to make them at the beginning of this bear market. If it turns into this and a bear market ensues, then we want to have taken action towards the beginning so that we're out of the way of most of this, right? Now, what is the risk to that? The risk to that is that we step out and it's just a small blip and we miss a little bit on the upside, right? So we understand that risk, and we hope that as clients that you understand that risk, that there will be times when we lag an uptrending market simply because we're trying to protect you. So that will happen. But the idea is that we sidestep some of this big loss and keep our clients more stable, keep them on more of a total return basis, and stay in line with what your goals are. So here's kind of the final thing we want you to go away with, right? At the very beginning, Gary put up a slide that showed the market gauge there, and it showed we were in a risk neutral zone. So all of these candles here, each one of them represents a week in time. And so you'll notice over the last couple weeks is when we've had this steep decline, right? And last week, actually, during one point in the week, we got beneath the second level where we would have gone risk off. But it came back up before the week was over and finished here. And as of right now, this next week that we're in, it just started, so it's not showing us the whole week yet, but actually it has declined back down. And so, like I said, we're hovering above this bottom line here. So right now, what we want you to come away with is, per our analysis, the market is in a risk neutral zone. We are allocated not completely out of equities, but we have increased our defensive position for our clients. And going forward, if things continue to deteriorate another few percent, then we're going to be in the risk off zone, and we will be making those changes. And like I said, also we make these, we look at our signals and make changes on as frequently as a weekly basis. So hopefully this is giving you some insight into how we look at markets and where the current market is. We'll put our disclosure here on the end. We are not making any specific recommendations. Of course, you should meet with your financial advisor before you make any decisions. We're not recommending that you buy or sell any securities or products. We're just simply trying to analyze the markets and show you where things are as of now. We'll finish off with this slide and just give you our contact information. Please give us a call, jump on our website, send us a message, give us some feedback. If you have any questions, please contact us. We would love to talk to you. That's it for now. We will get another video up next month at the latest. Thanks.